Capitalism is a system of freedom. That's the slogan. But from the very beginning, freedom inside capitalism depended on one thing: ownership. Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. We are taught that capitalism liberated humanity from feudal hierarchy, that it replaced inherited privilege with merit, that it gave individuals the freedom to trade, innovate, and rise. And compared to medieval systems of fixed status, that story contains truth. Markets did expand opportunity. Trade did loosen rigid structures. Wealth became more fluid. But here's the uncomfortable question. When capitalism was born, who was actually free? To answer that, we rewind to the 16th and 17th centuries, the dawn of modern capitalism. This wasn't a world of garage startups and tech founders. It was a world of empires, charters, monopolies, gunpowder. In 1600, the British East India Company received a royal charter from Queen Elizabeth I. 2 years later, in 1602, the Dutch East India Company, the VOC, was formed. These were not ordinary businesses. They were joint stock corporations with state backing, monopoly privileges, and in the Dutch case, the power to wage war, negotiate treaties, and establish colonies. Let that sink in. The first major capitalist enterprises were not operating in free competition. They were granted exclusive rights by governments, protected by naval power, allowed to crush rivals. Shareholders enjoyed something revolutionary: limited liability, global profits, scalable returns. Risk was distributed. Capital was pooled. Ownership could be bought and sold. But let's be precise about the freedom that existed. It was a freedom to own shares in a monopoly backed by military force. If you were an investor in Amsterdam, you could buy a slice of a company controlling trade routes, spices, textiles, entire ports. You could grow rich without ever boarding a ship. Ownership became abstract. Returns became exponential. But if you were a local competitor in Asia, staring down cannons and exclusive contracts, your freedom looked very different. Capitalism did not emerge in a vacuum of liberty. It emerged intertwined with state power. The corporate form was a legal creation. Contracts were enforced by courts. Monopolies protected by navies. Property claims backed by armies. Markets require rules. Rules require force. From the beginning, capitalism was not freedom from the state. It was freedom structured by the state. Now let's leave the oceans and move to the soil. Between the 16th and 18th centuries in England, something transformative was happening: the enclosure movement. For centuries, rural communities had access to common lands, shared fields for grazing, farming, survival. These commons provided autonomy. Families could survive without selling their labor full-time. Then came enclosure. Through parliamentary acts and private agreements, common lands were fenced, privatized, consolidated. Communal survival became private property. Smallholders were displaced. Traditional rights vanished. Before enclosure, a peasant with common access could sustain modest independence. After enclosure, many had no choice but to enter the labor market. Capitalism didn't just free labor. It created labor markets by removing alternatives. Freedom of contract sounds different when your previous source of subsistence has been legally enclosed. Ownership mattered. It still does. Fast forward to 18th and 19th century Britain. The Industrial Revolution. Factories multiplied. Textile mills expanded. Steam power transformed production. Productivity exploded. Britain became the workshop of the world. But walk into a Manchester factory in 1830 and ask, who here is free? Workers labored 12 to 14 hours a day. Child labor was common. Safety standards were minimal. Wages fluctuated with market cycles. This isn't emotional rhetoric. It's documented economic history. Capitalism unleashed unprecedented productive power, but the distribution of freedom within that system? Uneven. Factory owners were free to allocate capital. Workers were free to accept employment or face unemployment and poverty. That distinction matters. Capitalism consistently rewards ownership of productive assets more than labor contribution alone. Owners receive profits and capital gains. Laborers receive wages. Profits can be reinvested. Wages are typically consumed. Over time, that difference compounds. That's why industrial wealth concentrated so dramatically in the 19th century. Figures like Andrew Carnegie and John D. Rockefeller didn't just work harder. They owned railroads, oil refineries, steel mills. Ownership amplified freedom. Labor remained constrained by bargaining power. By the late 19th century, the Gilded Age revealed the pattern clearly. Massive fortunes, massive inequality. When financial crises hit, like the Panic of 1873 or 1893, industrial magnates made decisions that rippled across nations. Workers bore unemployment. Farmers faced foreclosure. The freedom to speculate carried consequences for those without buffers. And yet, the narrative of capitalism as freedom only grew stronger because compared to rigid aristocracy, markets felt dynamic. Compared to state command systems, private enterprise felt voluntary. Innovation was visible. Fortunes were dramatic. But visibility can obscure structure. A system that allows movement is not the same as a system that equalizes leverage. Capitalism reorganized power around property rights. Those who held enforceable claims over land, factories, ships, and eventually financial instruments possessed amplified agency. Those without such claims navigated within narrower margins. This is not condemnation. It's observation. Capitalism expanded freedom to trade, invest, accumulate beyond lineage. But growth does not eliminate hierarchy. It transforms it. Feudal systems tied power to bloodlines. Capitalist systems tied power to capital. The players changed. The structure of leverage remained. So when we say capitalism is about freedom, we should ask a sharper question. Freedom to do what? Freedom to work? Yes. Freedom to trade? Yes. Freedom to accumulate? Only if you have access to ownership. From its earliest corporations to its industrial titans, capitalism has consistently privileged control over productive assets. Without enforceable property rights, it collapses. Without courts, contracts fail. Without the state, capital is insecure. The real shift wasn't from power to freedom. It was from hereditary power to capital-based power. And that changed everything, including who could rise, who remained dependent, and how wealth compounded across generations. By the end of the 19th century, the pattern was unmistakable. Capital ownership generated exponential returns. Labor generated income, and that difference shaped the modern world. Both were necessary, but they were never equal in leverage. The promise of capitalism was opportunity. The mechanism of capitalism was ownership. And as we move into the 20th century, something even more powerful happens. The language of freedom becomes inseparable from the system itself. Before we go there, sit with attention. Capitalism expanded liberty beyond feudal constraint, but it embedded that liberty inside property and capital. The real question was never whether capitalism created freedom. The real question was, whose freedom did it prioritize? And that distinction becomes sharper in the modern era. By the mid-20th century, capitalism was no longer just an economic system. It became a political identity. After World War II, the globe split into rival ideologies. On one side, centrally planned communist states. On the other, market economies led by the United States and Western Europe. In that geopolitical battle, capitalism stopped being described as a structure of ownership. It was reframed as freedom itself. Freedom to choose. Freedom to speak. Freedom to trade. The Cold War hardened this narrative. Markets became synonymous with liberty. State planning became synonymous with oppression. Economists like Milton Friedman argued that economic freedom was a prerequisite for political freedom. And in many ways, that argument resonated. Private enterprise decentralized power. It limited direct state control. It fueled innovation. But something subtle shifted. Capitalism stopped being described as a system of incentives. It became a moral identity. And when a system becomes moral identity, critique begins to feel like betrayal. Yet the post-war decades were not pure laissez-faire capitalism. They were heavily managed. Central banks guided monetary policy. Governments funded infrastructure, education, defense. Labor unions negotiated wages. Industries were regulated. From 1945 to the early 1970s, much of the Western world experienced broad middle-class expansion. Wages rose alongside productivity. Home ownership expanded. Safety nets strengthened. Capitalism appeared to deliver shared prosperity. But look closer. Wages provided stability. Ownership created leverage. Then came the 1970s. Inflation surged. Oil shocks disrupted supply chains. Stagflation undermined confidence in state-led economic management. The pendulum swung. Deregulation. Financial liberalization. Global capital mobility. Late 20th century capitalism increasingly revolved around financial markets. Stocks, bonds, real estate, derivatives. Again, the rhetoric was freedom. Free markets from regulation. Free capital from borders. Free industries from government control. But mechanically, something else was happening. When financial markets expand, asset prices become central. Those who own appreciating assets see their balance sheets grow. Those who rely solely on wages remain tied to incremental income. Since the 1980s, equity markets have delivered substantial long-term returns. Real estate in major cities has multiplied in value. Financial instruments have become more sophisticated and more powerful. Meanwhile, wage growth in many advanced economies has lagged productivity. This is not conspiracy. It is arithmetic. Assets compound. Wages accumulate. There is a difference. Now consider 2008. Leading up to the crisis, financial institutions leveraged complex mortgage-backed securities tied to housing markets. When the system cracked, governments intervened at extraordinary scale. The Federal Reserve expanded its balance sheet dramatically. The U.S. Treasury injected capital into banks. Central banks across the globe coordinated liquidity support. The goal was stability. And arguably, a deeper collapse was prevented. But examine the structure. Institutions deemed systemically important were rescued. Asset prices eventually recovered, then surged. Homeowners facing foreclosure experienced a very different version of market discipline. Nothing says pure free market like trillion-dollar backstops. This is not moral outrage. It is structural observation. Capitalism has always operated inside political architecture. When systemic risk threatens capital itself, the state intervenes. Freedom exists within guardrails. Fast forward to the pandemic era. Governments and central banks unleashed unprecedented stimulus. Trillions entered the global economy. Interest rates were suppressed. Liquidity flooded markets. Asset prices soared. Stock indices hit records. Housing markets surged. Technology valuations climbed. At the same time, inflation returned. Housing, energy, food costs rose sharply. Wages adjusted, but unevenly. Those holding diversified assets saw net worth expand rapidly. Those living paycheck to paycheck felt erosion. The system didn't collapse. It recalibrated, but the asymmetry remained. If you owned assets, volatility could be navigated. If you depended entirely on wages, volatility felt like vulnerability. This is the modern expression of a centuries-old pattern. Capitalism prioritizes enforceable property rights. It protects ownership claims. It channels incentives toward accumulation. It generates mobility, yes. Entrepreneurs rise. Immigrants build businesses. New industries create fortunes. That dynamism is real, but mobility operates within structure. Ownership compounds faster than labor, and that is the persistent tension. Capitalism was never simply about removing coercion. It was about redefining power. Under feudalism, power flowed from lineage and monarch-granted land. Under capitalism, power flows from enforceable claims on productive assets. Freedom expanded, but it attached itself to capital. The freedom to start a business depends on credit access. The freedom to invest depends on surplus savings. The freedom to withstand downturns depends on buffers. These are not moral flaws. They are structural realities. So is capitalism ever about freedom? Yes. It dismantled rigid hereditary hierarchies. It unleashed trade and innovation. It allowed wealth beyond aristocratic bloodlines. But it also reorganized dependency. It shifted leverage toward owners of capital. It embedded liberty inside state-protected property rights. Capitalism did not abolish power. It redistributed it. Understanding that is not ideology. It is financial literacy. If you want wealth, understand ownership. If you want financial freedom, understand leverage. If you want to navigate markets intelligently, understand that freedom inside them is conditioned by access to assets and institutional protection. History does not offer moral simplicity. It offers structure. Capitalism is neither pure liberation nor pure exploitation. It is a system of incentives built around property, profit, and compounding. It expands opportunity. It stratifies advantage. The mistake is treating it like a slogan. The smarter move is asking better questions. Who owns the assets? Who writes the rules? Who absorbs the risk? Who captures the upside? Those questions matter more than whether we call the system free. History doesn't repeat. But if you don't understand how power reorganizes itself, you will mistake structure for destiny. If this changed how you see money and power, subscribe. History has the answers. I'll show you where to look.